Hi everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predicting gold prices. So I was pretty bullish last month on gold and it has gone up, but then it started to correct. Well, gold cannot keep on rising forever, so we do need corrections. The question is, where do we go from here for the next month? And for that, we just look at the gold forecaster index, which is based on leading indicators. And our new data point, as you can see here, is finally in the positive. So this is good news. It's actually pretty big in the positive. It looks like something that happens somewhere here. And that's when gold starts to rise much more in the coming months. Also looks something like here, and then gold starts to make a run upwards. So it could also be something like this here, and making a bottom. So however you look at it, this is bullish. Same here, then it makes a run up. So I expect gold to go higher in the coming months based on these leading indicators. Taylor rule is going negative. That's not so good, but it's not really that much. It's just almost at zero. It's not like we're like this. If it goes even lower, then then we need to be more cautious. Misery index, I think this is going higher. Unemployment rate should be going high. Inflation is not subsiding, so this should be good for gold. Real output starting to bottom out. That's good, which means gold will bottom out as well. Chile, Peru, not going to look at that. GLD stock level. Yeah, this is still going lower. The West still doesn't want to buy gold. They are just selling gold. Only the Chinese are buying. At some point, they will realize that this is the wrong way to go and they should be buying it again. And then it will shoot much higher. COMEX numbers the same. They're still selling. At some point, the selling will stop. Probably somewhere when this blue line hits almost zero, then we have a bottom in the selling in the West. But it's not done yet. LBMA the same, still selling, silver also selling. Yeah, when are they going to pivot? Gold demand in China was flat. Gold imports India down a bit. Seasonally, I think. Yeah, typically it goes down somewhere January, April, and then they come back by the end of the year. So this is probably a bottom and then will move higher. India silver imports are very good. They are buying a lot of silver. We need to see this continue, but it's looking good for silver. For SLV, still selling in the SLV. Still no interest, also not in the PSLV Sprott Trust. Nobody is buying silver in the West. Shanghai silver inventory is hitting a low. I could say that this is because of low demand, destocking. We need to see this go back up and then silver could go higher. This is actually not that bullish. We need to see that revert. COMEX silver. Actually, here we see a bottoming out. So at the COMEX, there are people buying. Okay. Yeah, this is the bond stock correlation. It's a long-term chart. We are currently positive in bond stock correlation, but look at this. This typically bond and stocks are positively correlated throughout history. So this is just a phenomenon that's anomaly that's only occurring once in a decade. Normally, bonds and stocks are positive correlated. So both go up and down together. That's from history, which means that we should be in this zone. So higher yields is good for gold. And that's what we want to see. China central bank buying is picking up again. Let's see where this goes. It's looking good. China really does want to get rid of treasuries. So the gray line, the gray bars are decreasing from 20 to 18 and gold going up from 3 to 3.5. So I expect this to continue in the coming years. They will get rid of this and put it into this. This is the long-term chart. You can see that gold is rising and they are selling the treasuries. Mint sales down, probably seasonally. Over to premiums. Yeah, the West still is not buying. Premiums are very low. Junk silver premiums also very low. But China is still buying. China premiums are currently at 1.3%. So still hasn't touched the zero line. Still above 0%. So I expect gold to go higher based on that. Silver premiums at 11%, very high. I expect silver to do very good. And we know China is currently on holiday. Next week they're back, and then we will see a continuation in gold and silver going up. Upmex, yeah, the West is not interested in gold. We know that. Let's take a look at PSLV. I expect this also to be very weak, as nobody likes silver. So these are the premiums. And yep, still minus 4%. Nobody likes silver. COT report. Okay, so we had a lot of shorts here, a lot of commercial shorts. And yes, we have seen a smash in silver. So silver is being smashed down right now, which I called. This is a crash. And that's because the commercial banks are short, so they want to cover their shorts. They slam it down and then they can cover it. So this should be going higher, hopefully, so that the slams are gone. For gold, it's less pronounced. This is still neutral, but for silver, it was really bad. It's really in the negative. So there was more risk in a silver slam than a gold slam. But these are just temporary fluctuations, and the long-term trend is still up. Okay, Swiss franc is not doing that great. This should actually go up instead of down. Yeah, this is also not great. Real yields still falling. This needs to revert at some point. Same here, needs to revert. Seasonality, I know seasonality doesn't work anymore on gold, but anyway, we are still in May, June, so this is going to be a flat month going forward seasonally, and then China and India will come back by the end of the year. Okay, yeah, the bullish sentiment. I think people are too bullish currently on gold, extremely bullish. This is actually very bearish to me because each time when people are too bullish, then it starts to top out and come down. Yeah, that's a risk. Sentiment is too bullish. So we need to see this come back down. We need a retracement. But fundamentally, we are still going higher in gold. As yeah, we need to get to the money supply, currency in circulation. Gold still needs to move higher to 3,000 at some point. That's the long term. Here as well, this still needs to uninvert higher. So look at this as a spring that needs a coiled spring that needs to uncoil. Let's see Google Trends. I added stagflation here. That's the new trend currently. Slower growth and more inflation, which is good for gold normally. So let's see where we stand. So we can see here stagflation trend is up, which should be good for gold. Here it's in a rising trend. Lately it's down again because gold is down. Debt to GDP is still rising, which is correlated to gold moving higher. I think we are going to get more defense spending. So more deficits and less revenue, which means gold should go higher during these times. Gold typically moves higher when we have more deficits than revenue. And then I think the trend will be higher. Near-term forward spread was still in the negative somewhere here. So plenty of room to move higher with gold. We had an FOMC meeting where rates were still the same. I don't think they will cut rates that soon, but we will see. They did say that they wouldn't hike rates, so that's already good for gold. This is still our projection that they will start cutting rates this year. So we'll see. Rates should be coming down. Foreign gold deposits haven't moved a lot, still the same. Bank term funding program has ended, so we could see some bank failures, which is good for gold. You can see already cash is going down a bit. Even the big banks have cash outflows. Yeah, this is looking bad for banks, but good for gold. Okay. Let's go over the bank balance sheets. So another thing that we got from the FOMC meeting was that they would reduce QT. So they're going to sell less treasuries from, what was it, 60 billion per month to 25 billion. So you're going to see this red line is going to drop less. maybe drop like this, and at some point it will probably go back to QE when the cash in the treasury is at 0. Then they need to go back to QE. So yeah, we still see a runoff in all the central banks. They are decreasing the money supply, same here. So this blue line is going to move down slower from here on out. This is actually bullish for bonds and bullish for stocks as well. So this is the current balance sheet, cash in the banks. Yellen still has a lot of cash, so I don't see a crash in stocks yet until this goes back to 0. Bank reserves stable, less runoffs, so that will provide more liquidity. So yeah, stocks could do pretty well now. Bank reserves, yeah. So now they're abundant reserves, but they cannot go below a certain level. Yep. So Yellen still has enough money to keep these reserves flat. Other than that, I don't see any problems. Excess reserves, let's see. Do we have increase in loans? Okay, deposits up a bit and then down. Loans pretty flat, but still rising. So I don't see any problems in the credit market. It's pretty stable. So I don't see any crashes. Money supply flat and rising. Monetary base is rising. Okay, currency in circulation rising. This is all good for gold and stocks. Deficits. We got the US trade deficit numbers today. Let's see. So deficits pretty stable. Nothing big happening here on this chart. Trend is down, so more deficits coming, which is bad for the dollar. So I still am bearish dollars and would rather be in gold. Export price, import price down, export price also down, so not a lot of change. Here they are going up for the commodities. Imports and exports for Q1 up. Okay. So looks like economy is growing, right? And here we see, we see the trade balance headed lower. So normally the US dollar should also start going lower. That's good for gold. So I don't see the US dollar shooting up like this. That's not my base case. My base case is that the US dollar will stay flat here, being the reserve currency, maybe even drop a bit. Capacity utilization, let's see. For the last month, It went back up. That looks good. That's good for inflation. And we already see that inflation is moving higher. Let's look at the employment, because here we are going to get numbers on Friday. And this looks like a bottom. But when we look at the employment level, yeah, it's starting to top out a bit, employment. And here the second derivative is looking to roll over. Yeah, so I think that at some point unemployment should go up. Job postings on Indeed down. Yeah, that's not good. So the trend is down, so that means that unemployment will go up. And this is actually the flash PMI. It says that employment is going down for the US. So I expect on Friday that unemployment will rise based on these numbers. That should boost gold on Friday. So let's see if that happens. You can see here also the PMI is correlated to the unemployment rate. So PMI employment index down means unemployment up. So I think that we could see a spike on Friday for gold based on the flash PMI. Some blog posts. I thought this was an interesting one. JP Morgan becomes custodian for JLD, and these two charts started to diverge. Let's see when they converge again, and then gold should be moving up. Gold minus still very low compared to the total global assets. So plenty of upside to come. We are invested in gold miners. China FX outflows continue, and this seems to be correlated to flows to gold. So the Chinese are flowing out of FX and going into gold. I think this could continue. Actually, the same with real estate. So the Chinese are fleeing out of real estate, home prices dropping, and then they are moving into gold. So that's a new trend. Chinese are moving out of real estate and forex into gold. Stagflation, what should we do in this period of stagflation? And actually, we did have some periods of stagflation in the past. The biggest one in the 1970s. And stagflation means that you have a lot of inflation, so the brown line, and low GDP growth, and that's the blue line. So what do we do in stagflation? We buy gold. As you can see, gold and commodities. And we avoid tech. We avoid the US dollar. We avoid bonds. You can see a lot of bonds here at the bottom. These are the things to avoid. I would also avoid oil because oil needs to have growth. If we don't have growth, then demand should fall. So there is a component that's bad for oil in stagflation. For gold, it's both good. If we have a recession, that's good for gold. And if we have inflation, that's also good for gold. So gold is a place to be. And when we have these spikes in stagflation, then gold also normally should spike. This is probably this spike here, and then it went back down. So I expect this to spike upwards based on stagflation. This is a nice chart that I just created, and it tells us the free cash flow yield of gold miners. So this is the blue line, free cash flow yield at 4% historically. Even if the gold price goes up, sometimes this free cash flow doesn't rise with it because of costs, because of market cap. But look at where we are now. We are now at 8% free cash flow yield. So we are extremely cheap historically. And you can see that here as well. That's the free cash flow yield. We are undervalued currently at the current gold price. And this free cash flow yield is typically correlated with the Huey index, gold miner index. So free cash flow up, gold miners up, down, up, and we are now completely undervalued. So this Huey index should be somewhere here. So I think this gap will close at some point. So that's why we are invested in gold miners. Bonds are trash, and here you see the evidence. We had a long period where bonds were very good. So yields going down means bond prices go up. And why is that? Because you can see the red line, that's the interest payments as a percentage of debt was going down. Okay, they had to pay less interest on the debt, and that's because the interest rates went down. So yeah, the fiscal deficits were improving as a percent of the total debt. But now we are at a point where this is starting to revert back up because of high interest payments on the high debt. Yes, because the debt is now at 34 trillion, 35 trillion, interest rates going up. So that means that we have now more interest payments as a percentage of debt. And this is going to project it going to 2 trillion interest payments per year. So yeah, it's not looking good. We are now starting to bottom out on this chart. And this is correlated also with bond yields. So I expect in the long term that we could see a rise in bond yields. If we cannot get these interest payments under control, and if debt keeps on rising, this could be very critical. And this line here is the amount of actual interest payments. Look at how this is shooting higher. So that's the projection. Currently 1 trillion, going to 2 trillion in a few years. So yeah, it's probably not sustainable at some point. So we need to be in commodities, in gold. Are we in a bubble yet? We are not in a bubble yet. Look at this commodity index. They bought it and now they're selling again. So yeah, this is probably again a bottom. Instead of commodities, everyone is buying equities and bonds, still rising. So everyone is buying these overvalued equities at PEs of 25, overvalued bonds at only a yield of 4.5%, 5%, while those yields are probably going to rise further, so it's not a good buy. But anyway, people are still buying this 40-60 portfolio and ignoring the commodities. So what we are going to do is we are buying this one that nobody wants, and that's gold. So in conclusion, I think it's looking good. And I'm very happy to see that the gold forecaster index is finally in the positive. So this chart here, that's still loading. Hello. Okay, so this chart here, very positive. Finally getting in the plus, so I expect good things to come for gold in the coming months. We could still have a bit of a lag from this negative gold forecast index here, but maybe in 2 to 3 months we should move much higher based on this data point. Okay, so that was the update, and I'll see you next video. Bye.